All right, let's dive straight into this explainer. We're breaking down the two massive pillars of Indian taxation, direct and indirect taxes. And we're doing it with a bold, structured approach. Look, taxation isn't just about crunching numbers, right? It is literally the lifeblood of a nation's sovereignty. So today, we're unpacking the legal machinery powering one of the world's largest economies, and we're going to make it absolutely crystal clear. We've got an intense roadmap ahead of us today. 1. Constitutional power of taxation. 2. Income tax, core concepts. 3. The 5 heads of income. 4. Tax procedures and returns. 5. Understanding GST fundamentals. And 6. GST compliance and landmark rulings. We're going to move fast, map out the entire compliance journey from start to finish, and tackle 2 absolutely massive Supreme Court showdowns that fundamentally changed how the government collects its revenue.
Section 1. Constitutional power of taxation. Let's start at the absolute bedrock of the land.
Before we even think about rates or deadlines, we have to look at Article 265 of the Constitution. It states clearly, no tax shall be levied or collected except by authority of law. The government cannot take a single rupee from your pocket without strict, explicit parliamentary or state legislative backing. It's a powerful constitutional shield, ensuring that taxation is never arbitrary, but always grounded in absolute legal authority. Section 2, Income Tax Core Concepts. Let's shift gears into our first massive pillar, direct taxation under the Income Tax Act of 1961. To really navigate this space, you've got to lock down some fundamental English legal terms. The assessee under Section 2.7, that's the person actually liable to pay the tax. But the real trick here, mastering the timeline. The previous year is the financial year where you actually earn the cash. Think April 1st to March 31st. The assessment year, though, is that subsequent 12-month window where that specific income is evaluated, assessed, and ultimately taxed. You earn in the previous year, and you do the paperwork and pay in the assessment year. Keep those two distinctly separated in your mind. Now, who exactly gets taxed? Well, that depends entirely on your physical footprint in India. A resident and ordinarily resident, an ROR, is caught in a massive global tax net. India taxes their worldwide income. But if you're a non-resident, that net shrinks dramatically. India's only going to tax the income you generate locally, right there within its borders. It's a precise, calculated net based on your exact days spent on Indian soil. Section 3. The 5 heads of income. How exactly does the Act categorize all this money? It systematically filters every single rupee an assessee makes into specific legally defined buckets to get your gross total income. Here's the aggressive breakdown. 1. Salaries. And keep in mind that comes with a standard deduction of 75,000 rupees under the new regime. 2. Income from house property, giving you a flat 30% standard deduction on the net annual value. 3. Profits and gains of business or profession, where business expenses get rigorously deducted. 4. Capital gains. And 5. Income from other sources, basically the residual catch-all bucket for everything from stock dividends to that winning lottery ticket. Let's zoom in on that 4th head, capital gains. The law sharply divides your assets into short-term and long-term capital assets, usually separated by a 36-month threshold. Sell a property before that, it's short-term, hit with standard rates. Hold it longer, it's a long-term capital asset. And here's where it gets highly strategic. Recent budgets completely wiped out the indexation benefit for adjusting against inflation, but they compensated by offering a flat concessional tax rate of 12.5% for long-term gains. It totally alters the tax liability math for investors. But what happens when the law's strict definitions just completely break down? Like, can you tax the sale of a business's self-generated goodwill if there's absolutely no ascertainable cost of acquisition? You didn't buy it, right? You built it from scratch over decades. Well, this dramatic question sparked a monumental legal clash. Enter the landmark Supreme Court case, CIT versus BC Srinivasasadi. Let's run a quick FIRAC analysis here. The issue was whether self-generated goodwill attracts capital gains tax. The rule involves Section 45, the charging section, saying capital gains shall be taxed, and Section 48, the computation section, saying you calculate it by taking the sale price minus the cost of acquisition. The court's powerful conclusion? If you can't figure out the cost of acquisition, the computation machinery totally breaks down. And if computation fails, the charging section fails completely with it. No tax. It's literally like trying to write a speeding ticket without knowing how fast the car was actually going. Without that baseline, the whole equation collapses. This ruling was so massive, Parliament actually had to step in and amend the law to deem the cost of self-generated goodwill as nil. Section 4, Tax Procedures and Returns. Let's hit the compliance battlefield. The government tracks all of this income through infrastructure like your PAN, tax deducted at source, or TDS, and some very unforgiving statutory deadlines under Section 139. July 31st, individuals who don't need an audit must file. October 31st, the hard deadline for companies and heavy-duty audit cases. Missed it? Well, you have until December 31st to file a belated return, but expect to be hit with penalties. It is a relentless, commanding march of compliance.
Section 5, Understanding GST Fundamentals. This brings us to our second massive pillar.
Back on July 1st, 2017, India executed a historic shift from taxing individual income to taxing the supply of goods and services. Welcome to GST. Because India is a federal structure, GST isn't just one monolithic tax. Under Article 246A, it's split systematically. You've got CGST for the center and SGST for the state on local supplies. For interstate commerce, there's IGST, which is integrated and then apportioned to the destination state. Remember, it's a destination-based consumption tax. The revenue flows to where the goods are finally consumed, not where they're made. Now, the absolute genius of GST is the input tax credit, or ITC. It prevents the disastrous cascading effect of paying a tax on a tax. But the government doesn't just hand it over. Under Section 16, you have to clear these sequential hurdles. You must possess the tax invoice. You must actually receive the goods. Crucially, your supplier must actually pay that tax to the government. You have to file your return, and you must pay your supplier within 180 days. Drop the ball on any of those steps, your credit gets blocked.
Section 6, GST Compliance and Landmark Rulings. Let's talk about how this tax actually gets paid.
In a normal charge, you buy a laptop, the store collects the GST from you, and they pay the government. Simple enough. But Section 9.3 introduces the reverse charge mechanism, or RCM. Here, the entire flow flips. The recipient of the goods or services bypasses the supplier and pays the tax directly to the government. It's a mechanism used for tricky sectors, like imports or transport agencies, to make absolutely sure no revenue escapes the net.
And this sets up a massive legal conflict. Imagine you're importing goods. You pay IGST on the total value, which covers the goods, the insurance, and the ocean freight. So can the government then turn around and use the reverse charge mechanism to aggressively slap a second IGST specifically on that ocean freight? That was the core battle in the 2022 landmark case Mohit Minerals versus Union of India. The Supreme Court delivered a stunning two-punch resolution here. First, they ruled that taxing the ocean freight separately when the importer already paid IGST on the total value is straight-up unconstitutional double taxation. Second, and this is a huge deal for the nation's legal framework, the court ruled that the recommendations of the powerful GST Council are not absolutely binding on the center and states. They're highly persuasive, sure, but they don't override the sovereign power of the legislatures. That ruling directly interprets Article 279A of the Constitution, which established the GST Council in the first place. The court emphasized that Article 279A is designed for cooperative federalism, not absolute rigid federalism. The center and states have to work together. Neither side holds a strict constitutional veto over the other. So let's bring this whole picture together. Direct income tax, driven by the strict mechanics of gross total income, and indirect GST, driven by the seamless flow of input tax credits, these act as the twin engines of the economy. Together, under Article 266, they pour straight into the Consolidated Fund of India, literally fueling every road, hospital, and defense initiative in the country. They're totally different in mechanism, but entirely unified in purpose. We've covered the foundations, the computations, the strict compliances, and the massive legal battles to fighting Indian taxation. But looking at the Mohit Minerals ruling and that constant push and pull between the center and the states, we really have to ask ourselves, as global financial systems rapidly evolve, will this delicate constitutional balance of cooperative federalism withstand the test of future economic crises? That is the ultimate question for the next generation of tax laws. Thanks for joining me on this explainer.